All right. Well, hi everyone, and welcome back to another season of the Microstructure Exchange. It's great to see all of you here again, and I hope you had a nice summer. I just wanted to let you know that the agenda for the fall series is on the website and on the calendar. We're going to have 7 talks. So today we're going to start things off with Vincent Glode. Our next talk is going to be next week, and then after next week, then our talks are going to be every other week from there on out, for a total of 7. So today, as I mentioned, Vincent is going to be presenting on ARM sales in financial markets. Vincent has requested that we take questions in 2 batches. First batch around the 15-minute mark, and then he'll pause for another batch around the 30-minute mark. But if you have clarifying questions, feel free to interrupt and ask those throughout. All right, so without further ado, I'll turn it over to Vincent. Please take it away.
Okay, well, first, thank you so much for inviting me. I'm very happy to be here. This paper is co-authored with Xingtan Zhang, who's usually at Colorado at Boulder, but now I can see from Zoom, he's in outer space. So I'm glad he was able to make it. So this paper is titled ARM Sales in Financial Markets, right? And as is a theme of several of my papers, this paper tried to understand, the implications of the fact that many financial transactions are of a fixed sum nature, meaning that improvements in the terms of trade for one party come at the expense of another party. If I'm trading with Josh and Josh is able to get a slightly better price, that means I got a slightly worse price from the improvement to Josh's terms of trade. Now, in order to gain relative advantages over their counterparties, many financial institutions have spent astronomical sums of money trying to acquire better data, better computer, hire smarter traders, perhaps trade faster. So, although our paper is not only about the high-frequency trading world, it definitely rings like a good setting for us. And in Michael Lewis's book, Flash Boys, Michael Lewis wrote, by the summer of 2013, the world's financial markets were designed to maximize the number of collisions between ordinary investors and high-frequency traders. At the expense of ordinary investors and for the benefit of high-frequency traders, exchanges, Wall Street banks, and online brokerage firms. Around those collisions, an entire ecosystem had arisen. So our paper is about that ecosystem, the ecosystem that feeds some traders with trading advantages that can be used against other traders, right? So you can think of advantages such as better data, co-location services, trading priority within a trading pool or dark pool. These trading advantages make a subset of traders better off at the expense of others. Now, if you're that ecosystem who collects revenues from providing that trading advantage, you need to account for the fixed sum nature of trading, right? Why is that? Because in a recent survey of US investors, 41% of individuals who are not participating in financial markets or in the stock markets blame the fact that financial markets were rigged against them for their non-participation. So there's a significant fraction of potential investors who don't want to be to participate in financial markets because they're worried about the other side. So we propose a model to study how the sales of these trading advantages, goods and services that impose negative externalities on your counterparties will affect financial market outcomes such as market participation, trading volume, and liquidity. So in our model, we'll have a monopolistic seller that prices the trading advantages that are made available to all potential traders. And then potential traders will differ. In our case, we'll assume that they differ in the ability to supply liquidity to counterparties, which means some of them will have incentives to participate and some of them will have incentives to acquire the trading advantage and others won't, depending on their type. And the market participation decisions of these traders will affect the value of their trading advantages And the sales of trading advantages will affect market participation. So we'll focus on that feedback loop between trading advantages and market participation. So clearly, I'm going to go through all these details during the next 45 minutes, but just so that you know where I'm driving with all this, I'll give you a brief summary of our main results. So the seller will maximize its profits by pricing the trading advantage higher than in a standard monopolist problem. I will often compare our results to the standard monopolist problem because the standard monopolist problem is one where the only elasticity that matters is price versus quantity. But here we're going to have externalities that will lead to a second externality. Right? So low participation in the financial market will reduce how often I get to use a trading advantage against counterparties. Therefore, it will reduce the value of that advantage to the potential buyers. So this second elasticity will drive some of our results. So by providing advantages to a subset of traders, by providing Albert and Marius and Andre with very fast access to financial markets, then I might lead, say, Xingtan and myself to exit the markets and make the trading advantage less attractive or less valuable to Albert, Marius, and Andre. So the optimal pricing strategy for the seller might still result in what we call socially excessive sales of these trading advantages. So these trading advantages will benefit a subset of market participants, but it will destroy surplus from trade due to the non-participation of myself and Xingtan. So in some cases, the subset of traders that acquire the trading advantage will benefit from acquiring it, right? From the sales of the trading advantages. But in other cases, we'll show that even the traders who acquire the trading advantage will prefer if that trading advantage didn't exist, because that trading advantage in equilibrium will lead to too much non-participation. It will make markets too rigged. I don't think I'm going to have time to go over this today, but in the paper, we investigate how modifying the market structure can affect the equilibrium behaviors by traders and by the seller of their trading advantage, and how we can, in a way, improve or fix the markets. Okay, so let's start with the model now. So first, warning, we're trying to model our financial market as transparently as possible. There won't be anything that we don't need to have in our model. So there's no exogenous, noise trading, no risk aversion, no market maker. There's very little market microstructure, in fact. There's just a fixed sum game among traders. And that's what we want to focus on. We want to focus on the sales of trading advantages that can be used in a fixed sum game. So consider a simple financial market with a continuum of agents. Right now, I call them agents because they are potential traders, but they might decide not to participate. Once they participate, we call them traders, but for now, let's just call them agents. Each agent I has a type theta I, which denotes a probability that this agent will be put in position to supply liquidity to the market at time 1. With probability 1 minus theta I, however, this agent is hit by liquidity shock and demands liquidity from agents in position to supply it. Think of exchanging an illiquid asset for cash. So what's important here is not so much that we're talking about a liquidity shock, liquidity demand, liquidity supply, but that one trader needs a trade and the other trader can take advantage of that need. So the theta I, the type, is distributed according to a CDF. And mu, we won't see it much, but it denotes the population mean of theta. So optional interpretation, and you don't need to use that interpretation if you don't want to, but you can think of agents with a high theta I as hedge funds and market makers who tend to be positioned to take advantage of profitable transactions when they arise, whereas agents with a low theta I the agents are often on the other side of these trades. Traders who are, perhaps have inflexible trading needs, and they tend to be the reason why these profitable opportunities are there in the first place. So let's model how, financial transactions happen at t equal 1. So first, we assume that market participation creates a surplus. That's why these financial markets exist. Perhaps you benefit from diversifying your portfolio, or perhaps you have access to improved investment opportunities, but participation creates a surplus of delta. And then when the transaction happens, you might have to share that delta, right? And more specifically, if you're asked to supply liquidity by a counterparty, then it allows you to capture a share of that liquidity demander's surplus. So by supplying liquidity, agent I is able to extract a payoff omega times delta. So a share omega of the surplus delta, just from supplying liquidity to responding to a trading need. But there's also a second term here, which is equal to sigma times AI, where AI denotes whether the liquidity supplier acquired a trading advantage before the transaction, whether the liquidity supplier is a high-frequency trader or is an informed trader, right? So by providing liquidity, you're guaranteed to extract a share of the surplus, but you can get a bigger share by acquiring what we call a trading advantage: data, collocation, services, trading priority, and so on. That means the counterparty of agent I is left with the remaining surplus, 1 minus omega share of delta minus the term that the liquidity supplier is able to extract from acquiring the trading advantage. And we have micro foundations in various papers of like payoff functions that look like this, but here we prefer to stick with a reduced form like this and move on with the equilibrium feedback effects. So we assume that liquidity suppliers and demanders are matched randomly in the financial market, just so that the math is simple. So each liquidity supplier can fulfill the need of as many liquidity demander as there are. Right? So liquidity supplier has deep pockets and then can use its trading advantage to when supplying liquidity. But how often they get to use that trading advantage depends on participation in which is determined in equilibrium. So there will be a measured eta of transactions that each liquidity supplier will participate in, and it depends on who gets to participate in the market and your own type. So now thinking about the decisions that agents can take before transaction occurs at time equal 1, so the decisions that take place at time equals 0, then the monopolist chooses a price P to charge for the trading advantage. And just to simplify the algebra, we'll assume that the marginal cost of producing an extra trading advantage is 0. So let's say once I've collected all my fancy satellite data, selling it to a third person or fourth person, the marginal cost of the extra trading advantage is 0. Now, knowing the price P, each potential trader will choose whether to participate in the financial market, and if so, whether to acquire the trading advantage. Now, let's talk about the expected payoffs. And then after this slide, I'll take questions, right? Let's think about the expected payoff. So at time equals 0, I need to decide whether I want to participate and whether I want to acquire the trading advantage. So this is my payoff function. Before knowing whether I will become, I will be hit by liquidity shock or not, this is the payoff. So the first term here, you can see the hand, right? The pointer, right? So the first term here is, this is the probability that I'm hit by liquidity shock times the expected payoff from demanding liquidity. Here, this is the probability that I have enough liquidity. If I have enough liquidity, then I retain my surplus because I don't need to trade my own position. But then on top of that, I get a share of liquidity demanders surplus, and the transaction volume I participate in is denoted eta here. So this is telling me how often I get to use my trading advantage against liquidity demanders. And then finally, we have minus the price times the my action, whether I acquire the trading advantage or not. So this is equal to 1 if I do, and equal to 0 if I don't. So here you can see that my payoff function when I demand liquidity depends on the equilibrium strategies of all my potential liquidity suppliers who participate in the market. So it will depend on equilibrium choices. The payoff from providing liquidity, from supplying liquidity, will also depend on the transaction volume that I expect to face as if I have liquidity to supply. And that depends on the choices of agents in equilibrium. Finally, P is the price that the monopolist will find optimal to quote in equilibrium. So now here the model, like the way trade occurs or the matching occurs, it originates from various different market structures, right? Right now, what we have is random matching, but what we really need are two things. We need two things. The first thing is, what happens when I need liquidity depends on my liquidity supplier's decision to acquire the trading advantage or not. If Albert, Andre, and Marius acquire, better data, hire smart traders, and can trade faster, that makes it less attractive for me to trade against them. Number one. Number two, if I acquire trading advantage, then the more participants, more often I can use my trading advantage, the more valuable that trading advantage will be. Those are the two properties we really need. We just use like a random matching, but you can think of it as OTC or centralized. And as long as you give us these two properties, we will be fine. Okay, just one more slide and then I'll take questions. Okay, so just so that we talk about the equilibrium. The way to solve for an equilibrium in this case, because there's a lot of moving parts, we will start with an equilibrium of the trader's subgain. So for a given price that the monopolist is charging, we will solve for the equilibrium behavior by traders in terms of participation and the acquisition of a trading advantage. Since it is more attractive to participate in financial markets if you're more likely to be supplying liquidity, then the decision to participate will be defined by a cutoff, right? If my type is greater than a cutoff theta P, I participate. Similarly, since it's more attractive to acquire the trading advantage if you're going to supply liquidity often, then the equilibrium behavior will be determined by a cutoff. If my type is greater than theta A, I want to acquire the trading advantage, right? So here again, kind of think of it as, if I'm a very desperate retail investor who needs liquidity very often, I'm probably better off not participating in these markets, right? Similarly, if I'm a very sophisticated hedge fund who can participate in a lot of transactions, then it is tempting for me to acquire speed, better data, good employees. Now, the global equilibrium of the whole model will be characterized by the price P that the monopolist chooses that maximizes profit by triggering the optimal equilibrium of the trader subgain. So The monopolist will pick a P that triggers the equilibrium in what traders want to do. Let me take questions for now, if you have any.
Any questions?
Yeah, I have a question. So you're talking about participation by day traders or liquidity suppliers, because like pension funds and long-term investors, they don't trade as frequently. So they would still participate infrequently, but they will trade against these high-frequency traders. So I'm a little confused. Who you actually are worried about not participating?
Well, okay, yeah, sure. I mean, like I mentioned, any participants who end up, think of it like the people who won't participate in model are the people who if they were to be present in the market, will often be taken advantage of, right? So you can think of retail traders, you can think of unsophisticated institutional investors. Trading in markets where you have high frequency traders, for example, in your example, right, might not be attractive for these less sophisticated traders. In our model, the type, and that's something that, you know, it makes our, like all our equilibrium feedback loops easy to manage or easy to track. Everything will be driven by this one type. This one type is there to capture a lot of things, right? It captures what we call liquidity needs, but what it really captures is whether you are going to be taken advantage of often, and if you're not being taken advantage of often, that means on the other hand you can take advantage of a lot of people, right? So that
I think, but I think most people would still participate. That's what I think. Practically speaking, if you have to save for retirement, you still participate. Whether you're paying 1 cent or $1 for the trade or $20, that's a little bit less relevant, right? So anyway, I'll stop there. Thank you.
Other questions? Okay, thank you. So in equilibrium, the total welfare will be very simple. It will be equal to theta, the benefit of an agent participating, times the mass of traders who find it optimal to participate, right? As simple as that. This will be decreasing in theta p, because remember, theta p is a cutoff for which if your type is above this cutoff, you participate. So it is decreasing in theta p. We want as much participation as possible if we want to maximize total welfare. So think of it as, you know, the 39% of US individuals who don't participate in financial markets, like from the survey I told you, 39% of these people don't participate in financial markets. So their diversification needs are not, they go unfulfilled by not participating in the market. So we'd like more participation here. Now, remember, in our model, the price P, what the monopolist does not affect the social surplus in terms of the transfer from traders to the monopolists. The only thing that matters is by setting this price P, the monopolist can trigger non-participation, which then lowers the social surplus. So that's what we're going to try to keep track of. So now let's solve for an equilibrium to the trader's subgain. So for a given P, we need to characterize a matching of liquidity demanders and suppliers for a given participation threshold. We need to characterize the trader's willingness to acquire the trading advantage captured by theta A. And then we need to verify that the participation decisions and the acquisition decisions are consistent in equilibrium. So let's look at the liquidity matching for now, right? So let's take the theta P as given. So there's a certain level of participation in the market. And now we'd like to know the transaction volume that each liquidity supplier is expecting to receive. So this is given by eta, where you can look here, the numerator is the measure of traders demanding liquidity in the market. So we take the integral from the participation cutoff to the upper bound of all the traders, and then 1 minus theta is the probability of demanding liquidity. So top part is the aggregate demand for liquidity. The bottom part is the mass of traders who can supply it. So eta is, you can think of it as, is the demand of liquidity per liquidity supplier. And again, this ratio is strictly decreasing in theta p. So you get to use your trading advantage. You get to provide liquidity more often if more traders participate in the market. So now, when thinking about agents' incentive to acquire the trading advantage, this is the payoff function I showed you. So we just need AI to maximize this profit function, right? We just need the agent I to be better off using that trading advantage with a mass eta of counterparties and paying a price P than not, right? So we can solve easily. So we just need P to be small enough, right? You need P to be smaller than the agent's type, which is a probability that this agent will get to supply liquidity, times the quantity of transactions, the volume of transaction in which it will participate, times sigma, which is the premium you get from, or the extra payoff you get from having the trading advantage, right? And we can rewrite this way. So we can see that the agent's decision to acquire a trading advantage will be characterized by, again, a cutoff, theta A, right? So as long as your type, as long as you're more likely to provide liquidity than theta A, you will want to take that, to acquire that trading advantage and pay the price P. What about participating? Well, participating just requires that this payoff function that I showed you before is greater than 0, because we normalize the payoff from non-participation to 0. So here, you can see I will participate if my payoff function is greater than 0, but part of my payoff function comes from what happens when I demand liquidity. And this is an expectation because I'm randomly matched with counterparties. So I need to take the expectation of my counterparties' strategies or decisions with regards to acquiring or not the trading advantage. So we can solve for this, the expected acquisition of trading advantage by my counterparties, just using kind of the cutoffs that I showed you earlier. So key takeaways from this equilibrium so far, this equilibrium analysis so far. First, agents' participation decisions depend on their counterparty's advantage acquisition. If I'm afraid that Albert, Marius, and Henry will acquire a lot of trading advantages, that makes it less attractive for me to participate, because if I need to trade against them, they'll take advantage of me. Right? And going back to the survey evidence from earlier, if I feel like markets are rigged, participation is less attractive. Now, another feedback effect there is the fact that my decision to acquire the trading advantage will be strengthened by my counterparty's demand for liquidity, which increase with participation. So if I believe that everyone in this room will participate, and I'll have the opportunity to use my fast trading system or my superior data against a lot of them, it makes it more attractive for me to acquire these trading advantages. Albert.
Just a clarification question. Because I'm trying to still follow the it's somewhat non-standard, so I'm trying to figure out to get my mind through the. But I understand why you set it up this way, because otherwise it becomes too complicated. But when I think the random matching that you have here, it kills one channel, and the channel is that if I buy the arms. Since it's random matching, I'm not in the way of other people supplying liquidity or buying the arms. I'm not sort of getting an advantage of getting more customers because the matching is random, right? So we're killing that channel, and that's potentially an important channel that if I invest heavily in this type of technology, I might offer people better deals because, for example, I'm keeping adverse selection low or whatever it is. And that's okay. I just wanted to make sure that that's part of the model. The random matching is a bit unusual, and but has potentially significant drawbacks. I just wanted to clarify if I get that right or not.
So I'm not sure what you would like to see instead, right? Can you talk more about, like, if it was not random matching, what would you want traders to do?
Well, of course, we're coming from limit order markets, and if my technology allows me to simply show better quotes, then I'm attracting more of the traffic. I'm attracting more of the demand at the cost of other people. That's sort of the standard in many models. So I'm trying to see how this is different.
Yes. So think of our sigma, right? Like right now we have random matching, but the sigma is the boost and payoff you get. So you can see if you come. You can see sigma times eta. In your model, we will have both of them going up, right? I get a trading advantage per transaction, and I get to participate in more transaction. We will get the same effect. It will just be like a different. If we were to calibrate this model, we will have a different calibration, but it will go in the same direction. We just need one of the two things to go up, right? Think of it as, eta will be driven not by what you mentioned, but by participation. But it could be driven by participation and the fact that if I'm faster, I participate in more deals. But that second channel is captured by the sigma.
Okay, I get it. Thanks. Yeah.
Thank you. Okay, so now I want to point out something that makes financial markets interesting more than other industries, which is, think about, what we've been talking about. You're selling one good that gives an advantage to some parties, but not others. If, let's say, we're in the restaurant industry, I'm selling a really good recipe that gives some restaurants a better menu than others. In the restaurant industry, what you want is your rivals to disappear, to not participate. Whereas in finance, you need to be careful. If you're the only participant, because you're too strong, you're not going to be able to use that trading advantage against anyone else. So in finance, it's interesting. You want to acquire a trading advantage without triggering too much exit, because you're going to use that trading advantage to provide liquidity. You need liquidity demanders to be in the market if you want to be able to use that liquidity or that trading advantage. So now before we get to what the monopolist wants to do, let me show you a little bit of what the equilibrium of the trader subgame will look like, right? So here on the y-axis, you have theta p, and remember, theta p is the lower bound, the kind of the marginal type that is willing to participate, and anyone above theta p participates. On the x-axis, you have theta a, which is the same thing, but for acquiring the trading advantage. So you can look at the blue curve. Blue curve shows that if I'm increasing the price, it can increase market participation if marginal participants do not find it optimal to acquire the trading advantage. So by increasing the price, fewer people acquire the trading advantage, more people participate. That's the kind of the force I've been talking about for the last few minutes. But the red curve shows something that is also interesting, which is that if I'm only willing to participate in the market with the trading advantage, then lowering the price of the trading advantage makes it more likely that I acquire it, but also more likely that I participate. So you can have two effects going in different directions, depending on whether the last participant, the marginal participant, is acquiring or not the trading advantage. Now, let's take a step back and think about how the monopolists would like to sell the trading advantages to maximize profits, taking into account traders' equilibrium responses. So here, since the cost of the marginal cost of producing another unit of trading advantage is set to 0, and again, like we could have a non-zero C, we will just have a bunch of minus C's in all our equations, and we will get the same intuition. But we're trying to maximize P times the mass of traders who acquire the trading advantage. So here, I'm not going to go through all these equations, but what I want to emphasize here is that the first order condition for the monopolists can be written as the standard monopolist FOC, where H is a standard function that we see in, often see in bilateral bargaining. We often see this in auction theory, right? This is a standard monopolist FOC. And there's a second term. And this is the impact of selling your trading advantages on the endogenous participation. So here you can see, like, we will need, like, the monopolist will try to price the trading advantage based on the standard monopolist FOC plus an extra term that captures the non-participation elasticity to the sales of trading advantages. In equilibrium, this elasticity will be positive, meaning if I were to sell more trading advantages, it should lead to less participation. If instead we had a situation where I can sell more, like co-location services, and it led to more participation, I wouldn't be at an optimum, because I should keep selling more of these co-location services to have more participation and make co-location services more valuable. So at an equilibrium, we need this to be flipped. We need we need that elasticity to be the non-participation elasticity to be positive. Okay. So before I go over the first result, I think there are questions in the chat, and I think I owe you some answers. So I'm happy to take questions, whether it's from Josh reading the chat or anyone else.
Yeah, just one question in the chat here from Marius. Marius, if you want to just unmute yourself and ask it live, go ahead.
Hi, Vincent. This is a really interesting paper. So when I saw the red curve that actually making the advantage cheaper can increase participation, I was thinking of how IEX, for example, gives this special order types, like the repricing order types, like the deal limit. Would that be a natural way of thinking about this, like just making everybody cheaply co-located in some sense?
So bear in mind, this only works. So you by doing things, by reducing the price of the trading advantage, clearly you will make it more attractive for more people to buy it. But what's important for that red line is that the marginal participant is acquiring it. So like co-location will not be cheap enough for the retail investors in my survey at the beginning to like purchase it and therefore participate in markets, right? So we're like what you're suggesting is not the red line that I'm showing.
Okay, thanks.
Yes, another question?
Okay, go
Yeah,
ahead.
I have let me ask about this participation. You can vary, like for example, Kim and Verekia had a model where if you are afraid about being taken advantage of, you just reduce your depth, right? So you can trade like instead of 100 shares, you can trade one shipping with 10 shares or 5 shares. Is that also a solution to?
Yeah. I mean, in our case, it's you either participate or don't. But clearly, we could enrich a model with some quantity, right? You participate a lot, you don't participate much. We will get the same result. We just have a discrete decision now.
No, but on the other hand, it allows the participants to keep participating with changing prices with reduced quantity. So that's
Yeah,
how
but
I think around earnings announcement traders do all the time, even right now. Anyway, thanks. Yeah.
Other questions? Okay, let me keep going. Okay. So let me start with proposition 1, which is not the main result of a paper, but just like quickly. We showed in the paper that the monopolist will optimally quote a price that induces weekly less acquisition of trading advantages than in the standard monopolist problem, right? The monopolist, since the monopolist is internalizing the impact of quantity of trading advantages sold on participation, the monopolist will be weekly more careful than a monopolist when increasing quantity, when charging low prices. Okay. Now we can have optimal or we can have maximal participation, right? Proposition 2 shows that we can have a socially efficient level of market participation whenever sigma over delta is small enough, right? We need sigma over delta to be small enough, and then we have an equilibrium that is socially efficient. What does it mean, sigma over delta being small enough? It means that for small enough trading externalities, the monopolist will find it optimal to price these trading advantages in a way that it won't affect the endogenous participation of traders, right? These trading advantages are small, and what will end up biting is not the endogenous participation, but just a typical price quantity elasticity of the monopolist. So if the externality is small, we're back to the standard monopolist problem, right? Here I can show you what it looks like. If you look at panel B, you can see like this is the profit function for different prices. And you can see that the optimal price is here. It's roughly like almost 0.5. That's the optimal price for the monopolist. What you need to know also is that the kink that you see there arises when the level of market participation stops being efficient. So here, if the monopolist were to lower the price, we will be in an inefficient participation level or region. And here, if the monopolist were to increase the price, there will be fewer trading advantages, and we will still have full participation. So that kink is exactly where it is optimal for the monopolist to stop decreasing the price of the trading advantages. So in this situation, the monopolist sells as many trading advantages as possible up to the point where non-buyers still want to participate. Now, what if we look for situations where we don't have efficient participation? So again, that quantity is important. If that quantity is big enough, if sigma over delta is greater than K, and this expression is strictly positive, then the monopolist finds it optimal to sell enough trading advantages that it triggers partial participation. It leads to exit and the destruction of the participation surplus. right? So here I'm showing you this is the same profit function I showed you earlier, where the monopolist stops here and is satisfied with selling just enough trading advantages that we have full participation. This is a second case. This is where full participation stops being possible, but you can see that the monopolist finds it optimal to lower price, sell more trading advantages, but this leads to non-participation. So this is one thing that I want to mention, and then we can fly through the next few things, but this is important. So I will take a few minutes here, and then we can wrap up. But here I want to show you some comparative statics in equilibrium. What happens in equilibrium when you change sigma? Okay, as you make the trading advantage more powerful, what happens to equilibrium quantities? So let's look at the price charged by the monopolist. So I go from a weak trading advantage to a stronger trading advantage, and you can see that, unsurprisingly, the price goes up. But you might notice that it's not linear, right? You don't just make the price higher and higher. You also see some non-linearities. These non-linearities are there because at some point it becomes optimal to trigger non-participation. So here are the equilibrium thresholds. So this is the acquisition threshold. So remember, if your type is above that threshold, you acquire the trading advantage. So you can see as the trading advantage becomes more powerful, then you see the price goes up, and fewer people acquire that trading advantage. Yet, even though fewer and fewer traders are acquiring the trading advantage, you also see that as the trading advantage becomes stronger, you start having some non-participation. You start having fewer and fewer people participating. So as our trading advantages, the data becomes better, the trading speed is faster and faster, it starts becoming more optimal to sell enough of these trading advantages so that in equilibrium, markets appear to be rigged and some people exit. What's interesting is how different traders are impacted differently by this trading advantage. So here again, this is as I make the trading advantage more powerful, or you can think of it as, speed is faster, data is better, and so on. So this is the payoff for a trader whose theta is equal to 0.1. So you can see that trader is not acquiring the trading advantage anyway. So the fact that the trading advantage is more powerful hurts that unsophisticated investor. Same thing here, right? You can see like this is a trader whose theta is 0.5. So that trader, as the trading advantage of the sophisticated investor gets stronger, that trader gets, worse off. What's very surprising is this guy, right? This is the traders whose theta is equal to 0.9. And if you look here, you can see if your theta is equal to 0.9, you're always acquiring the trading advantage in that region. So that trader acquires a trading advantage. That trader initially is better off by the fact that by an improvement in the strength of the trading advantage, but at some point, that trader gets worse off because at some point, that trader benefits from having a stronger trading advantage, but now can use this trading advantage against fewer and fewer participants. So that trader starts at some point, kind of the evolution, the fact that the trading advantages are getting better and better, that trader is made worse off. So let me just conclude here in a few seconds. I want to talk about what we do in the paper that I didn't have time to talk about. We investigate how varying market structures, the market structure can affect the equilibrium behavior by traders, but also by the seller. So in the paper, we show that if we were able to segment traders across multiple venues by starting a venue that caters to, say, the retail investors who don't want to participate in the market, we could solve the problem. Because again, what really drives the inefficiency here is the fact that we have trader heterogeneity. We have some sophisticated traders and some unsophisticated traders meeting, bumping into each other, and that's what makes the less sophisticated traders wanting to exit. So if we were able to segment these venues so that we have less heterogeneity within venue, it will lead to more participation. We show in the paper that adding competition among sellers will worsen the efficiency of participation, because one thing that is great in our setup is that the monopolist internalizes the impact of its decisions on market participation. If we have a large number of sellers who take participation as given, they will be more aggressive in their pricing, and it will lead to even more trading advantages being sold. Finally, allowing the monopolist to price discriminate, so giving more market power to the monopolist, is also not a good solution, because the monopolist will be able to extract more from the marginal buyers, and therefore the monopolist will sell even more trading advantages, leading to more exit. So just to summarize, many financial transactions are of fixed sum nature. Trading advantages tend to be produced by profit maximizing entities. So in our paper, we try to understand these entities' incentives to produce and sell more trading advantages for traders. And unlike in most industries, the optimal sales of trading advantages must account for the endogenous participation of agents who choose not to acquire the advantages. So the seller's optimal pricing of trading advantages can result in inefficiently low levels of participation. It is optimal in some cases for the seller to sell the trading advantages enough so that it leads to non-participation, even though non-participation lowers the value of the trading advantages. So that's all I have for today. So thanks so much for your comments, and I'll stick around if you have more questions or comments.
All right, thank you very much, Vincent. And now let's open it up for more questions.
Henry.
Vincent, thank you so much for the talk. Was hoping to ask for a quick clarification on the on that case that you mentioned at the very end, when we have multiple competing, let's say, exchanges selling technology and trying to, I'm guessing the logic there is these exchanges sell technology to compete with each other for volume.
No. What the venues do in this setup, they're not generating more trading advantages. They're just changing the matching function that Albert was discussing, right? They just change who you might bump into. So let's say we are in a retail exchange, so we will only bump into retail investors, and there's this institutional exchange where you only have institutional investors. The trading advantage of better data isn't related to that, right? In this case, am I clear?
Yep.
Right, you still have the trading advantage, but now what we're changing is who you bump into as a trader, if you acquire it or if you don't.
Okay.
And the idea there again is that like, think about a situation where Albert, I'll go back to my example. Albert, Marius, and yourself, you acquire the speed, let's say, the speed advantage. And Xingtan and I don't. So we don't, let's say we're in that situation, we're too scared of you guys. Xingtan and I don't participate. Well, you can create value. You can boost the social surplus if you start a venue, an exchange just for Xingtan and I. who are not going to participate. Now, what's interesting there is that if you start an exchange for Xingtan and I, it's possible that Xingtan will now not only find it optimal to participate, but will also find it optimal to acquire speed, a speed advantage over me. So you have all of this occurring at the same time. Albert.
Got it.
So this all is super interesting. I look forward to diving deeper into it. One thing that I couldn't square is the you've decoupled becoming a supplier or demander of liquidity with the gains from trade, the delta, if I understood it correctly. So it doesn't really matter who's meeting who. The delta is just fixed, and that I'm having a bit of trouble chewing, because I feel that if I'm a low theta, if a low theta type meets a high theta type, so somebody really is a demander and somebody's really a supplier, I tend to feel
that's a good point.
Be higher.
If that's
true, how does it affect the results?
Yeah, right now it's a benefit of participating, not a benefit of trading, right? But in a previous draft, we modeled it your way. It was a benefit of trading, but then the problem is that with that interpretation, and like we got the same results. We like in terms of not the same equations, but the same economic results. But the problem there was the surplus was created by somebody who gets hit by a liquidity shock. So in other words, what we were getting was it was good for a lot of people to need liquidity all the time. So that led to welfare results that were a bit weird in that sense, right? The low liquidity traders were creating more surplus than the high liquidity traders, right? But in fact, it's a liquidity provision that creates a surplus. So in that case, we just like moved it, we switched it as a surplus from participation that is then split differently in the transaction, but we will get the same qualitative result. And I'm happy to send you the draft, but it led to more complications in the equilibrium derivation, but the same results.
No, thanks. I would love to. I mean, the discussion, it would be nice to discuss that in the paper, because it sounds to me like important. Anyways, I'm enjoying it. Thanks a lot.
Thank you, Albert. Josh.
Thanks again for the talk. So I was just wondering, in the way you've written down the model, it seems like you're looking at technologies that are helping only liquidity suppliers and not liquidity demanders. And so I was kind of wondering if it's important for the takeaways that this interaction is between technology and liquidity supply, because if I think about these technologies that you have in mind, like co-location or speed, it seems like these might help with latency arbitrage. And so, suppose we had like a different model where technologies are helping both sides, or maybe only the liquidity demander side. Would you get the same takeaways, or would the takeaways be fundamentally different?
So this is a very rich question. So I need to split it in two different parts, right? So our labeling of liquidity supplier, liquidity demander is just to help, right? But at the end of the day, you have two counterparties. They meet, whether it's because of liquidity, it's because of diversification. But what's important is that their type determines whether they want to acquire it or not, right? And in order to do this, we need being on one side to not have the same benefit as being on the other side. Meaning, if liquidity suppliers and liquidity demanders both got $5 for acquiring the trading advantage, then it wouldn't matter what type they are. In our case, what we say is we use theta I as the probability that you get to use it. And we call this liquidity supply, but it doesn't really matter, right? Like, so think of it as it's the hedge fund versus versus my uncle, right? my uncle is not going to get like pay for colocation services because, you know, my uncle trades every 5 years. In a recession, he freaks out, then he sells everything, right? And then there's a boom. His neighbors tell him to buy, then he buys everything, right? So that data is just really just capturing this, and we need kind of that heterogeneity. If we were, though, you could say like, yeah, still, we might want to have something asymmetric, yet both sides can use the trading advantage. Perhaps it's not worth $5 and $5, but perhaps it's worth $5 and $3, right? And in that case, what happens is that we start triggering multiple equilibria, where my benefit of acquiring acquiring the speed depends on whether you acquired it or not. And that opens a box that, again, I've done it in other papers where I show the robustness under like some equilibrium refinements if both agents can use what we call then financial expertise. So whether it's bilateral or not, we got similar results, but you open a door that is hard to close. But so those are the two reasons why we kept it simple like that. There's no reason to believe that the economics wouldn't be there like in some of the other papers. But again, we haven't done it.
Thanks. That's very helpful. I like this interpretation of theta as like hedge fund versus your uncle. I think that's another maybe very useful way to think about what theta is doing here.
Yeah.
Thanks.
PK.
Yeah, so how do you reconcile the empirical side, like there's increasing amount of investment in arms race for speed, and all of those speed bumps and all, they were actually removed, right? And they were not successful. And still, the retail traders retail participation has increased significantly in recent years. So it's a little bit goes opposite of your theory.
Yeah, a
Maybe
lot of
there are
things
other
happen,
things.
right? And like in the last few decades, a lot of things happen.
Right.
People are more educated. They have access to iPhones. They trade for free. A lot of things have happened that are not in our model. So, like explaining trends, like macro trends, like that is a bit difficult with a 2-date models with everyone research role and yeah. But I hope you remember the survey evidence I mentioned at the beginning, that there are people who are worried. A significant fraction of U.S. individuals are worried about markets being rigged, and what we're saying is that then it should be part of the equation for these market participants.
Well, that's true for everything. People believe politics is rigged and everything is rigged, right? Jobs are rigged. So.
Yeah, but
is that just anecdotal, or is there any real concern that people really stop participating, thinking that markets are?
Yeah, but if like right now there's 16% of U.S. adults who don't participate in financial market in the stock market, right? Okay. Because no, sorry. There's 39% of U.S. adults who don't participate. And within 39, you have 16 that don't participate because they think that markets are rigged. There are other people who don't participate because they don't have the money, they don't have the, right? But there are a total of 16% who don't participate and say it's because their markets are rigged. So these people are not, first, it's probably bad for them that they're not better diversified. I assume all their money is invested in a bank account or perhaps in their own
I think what they're worried about is the rigged by corporate insiders, because they will present a rosy picture and then the stock goes to zero. Right? That is what maybe they're talking about, not that somebody has a slight advantage over you. So that rigged definition is not all about speed, I think. Right?
They're worried about being taken advantage of, and in our case, we model this trading advantage. That trading advantage can be something that insiders acquire as well. That's
okay.
Other questions?
All right, if we have no other questions, just like to thank Vincent once again for a very interesting talk. And we hope to see you all back here in 1 week for the next iteration of the microstructure exchange. Thanks, everyone.
Thanks for your comments.